So let me ask you a question. What kind of stock do you think actually returns roughly 649% over a single decade? Just think about that for a second. We aren't talking about some flashy tech startup here or the latest artificial intelligence darling. We're looking for a company with a proven, reliable engine of compounding intrinsic value. Well, the exact number is 649.10%, and that absolutely massive 10-year return belongs to ServisFirst Bank shares. But as analysts looking for rigorous fundamental value, past performance is really just the prologue. What we really need to figure out is whether the underlying financials justify buying the stock today. Welcome to The Explainer. Today, we're putting on our sell-side equity analyst hats to perform a rigorous fundamental valuation of ServisFirst Bank shares, ticker symbol SFBS. Our goal? To translate a dense wall of financial data into a clear, actionable model of this company's intrinsic value, relying strictly on the reported numbers. Here is our roadmap for The Explainer. First, a high-level snapshot. Second, breaking down the valuation. Third, a track record of growth. Fourth, the dividend income story. And finally, revealing the fair value. Section 1. SBFS, a high-level snapshot. Let's dive into it. ServisFirst Bank shares is a publicly traded financial stock, currently commanding a market capitalization of $4.34 billion. That puts it squarely in mid-cap territory, which is kind of a sweet spot. It's large enough to have established, stable operations, but still small enough to have a really meaningful runway for future growth. Looking at the current trading picture, the stock closed recently at $79.39 per share. And honestly, it's having a pretty solid year, posting an 11.76% return year to date. But as fundamental analysts, we don't buy past price action, right? We buy future cash flows. So we need to look under the hood to see exactly how much we're paying for those cash flows. Section 2. Breaking down the valuation. What's really interesting here is that ServisFirst is broadly trading at a noticeable discount compared to its own historical averages. Its price-to-earnings ratio sits at 14.65, which is almost 12% below its 5-year average. Its price-to-book ratio is 2.27, about 10% lower than usual. And perhaps most importantly for us, cash flow-focused investors, its price-to-free cash flow ratio is 12.43. That is a striking 14.22% discount to its 5-year norm. So on a historical relative valuation basis, the stock objectively looks cheaper today than it has in recent years. But here is where we have to be super careful. The current PE is 14.65, but the forward PE ratio jumps significantly to 22.57. When a forward multiple is higher than a trailing multiple, it usually implies that the market or analysts are expecting an earnings contraction in the near term. Essentially, we're paying a higher multiple for tomorrow's expected earnings than we are for today's actual earnings. This is absolutely a critical risk factor to keep in mind. That being said, the underlying health metrics remain incredibly robust. SFBS operates with a debt-to-equity ratio of just 0.83, which is actually 16% below its trailing 12-month average. That shows really conservative balance sheet management. The return on equity sits at a very healthy 15.50, meaning management is highly effective at compounding shareholder capital. And the cash generation power? It's massive. We're looking at an 8.05% free cash flow yield. To put that in perspective, for every $100 you invest, the underlying business is throwing off over $8 in pure free cash. That provides a massive margin of safety for the operations. Section 3. A track record of growth. Now, while the long-term trend has been spectacular, the year-to-year journey is definitely volatile. Just look at 2021. SBFBL delivered an eye-watering 113% return. 2024 was also stellar, up nearly 29%. But then, in 2025, the stock faced a drawdown of almost 14%. As analysts, we expect this kind of thing. Market prices fluctuate wildly, which is exactly why we anchor ourselves to the underlying financial growth rates rather than just getting caught up in stock price momentum. And when we look at those underlying financials, the compounding is just undeniable. Over the last 5 years, top-line revenue has grown at a compound annual growth rate of 19.16%. The trailing 12-month earnings per share CAGR is an explosive 31.14%. Even if we smooth things out over 5 years, net income has grown near 10% annually, and free cash flow has compounded at over 11.6% every single year. Make no mistake, this business is structurally expanding. And all of this growth has culminated in a major milestone.
Over the trailing 12 months, ServisFirst bank shares officially crossed the billion-dollar mark, pulling in $1.021 billion in revenue. They aren't just growing percentages on a spreadsheet anymore. They are generating serious, scaled, absolute dollar figures.
Section 4. The dividend income story. This number, right here, 12, is a literal badge of honor in the financial world. ServisFirst Bank Shares has achieved 12 consecutive yearly dividend increases. Management has committed to a consistent stated policy of returning capital to shareholders year in and year out, regardless of what the broader economy is doing. But as analysts running these models, the safety of that dividend is what we care about the most. The payout ratio sits at just 26.38%. So for every dollar of earnings SFBS generates, they only hand out roughly 26 cents to shareholders, retaining nearly 74 cents. That provides a massive buffer. Even if earnings were to temporarily drop, like that forward PE ratio might be hinting at, the dividend is heavily protected by this enormous cushion of retained earnings. Summarizing the dividend data, the current yield might seem a little modest at 1.92%. However, the 5-year dividend growth rate is nearly 14%. When you compound a dividend at 14% annually, your yield on your original investment simply skyrockets over time. In fact, if we apply a basic dividend discount model framework to that growth, the forward 10-year yield on cost is projected at a fantastic 4.97%. If you're a long-term investor, your income stream is growing rapidly. Oh, and for those keeping track, the next ex-dividend date to mark on your calendar is April 1st, 2026. Section 5. Revealing the fair value. All right, moment of truth. We have to bring all these metrics together. Based strictly on the discounted cash flow metrics and earnings models provided in our source data, what is the true absolute intrinsic worth of one single share of ServisFirst Bank shares today? The absolute valuation models present us with a really fascinating divergence. The standard baseline fair value price, which is heavily tied to their earnings per share, is calculated at $80.67. This gives us a razor-thin margin of safety of just 1.59%. However, when we run a discounted cash flow model based purely on their free cash flow generation, which, remember, we noted earlier was growing aggressively, the fair value literally explodes to $172.20. What this tells us is that SBFS is incredibly efficient at converting its operations into actual cash, far beyond what the strict accounting earnings might suggest. But as conservative analysts, if we stick to the primary EPS-driven fair value, the market is pricing this stock very closely to its base. The current price of $79.39 is practically hugging that fair value price of $80.67. The market is highly efficient here, pricing SBFS almost exactly at its calculated intrinsic base value. Which leaves us with this final thought to consider. You have a business with a proven 649% 10-year return, compounding free cash flow, and well over a decade of dividend increases. But today, the conservative margin of safety sits at barely over 1.5%. So is ServisFirst Bank shares currently priced for perfection, leaving little room for error? Or is paying fair value for a wonderful, consistently growing business exactly how great investments are made? Well, that's the question you have to answer for your own portfolio. Thanks for joining me on this explainer, and I'll see you next time.